becomes lesser and lesser.
Yes.
Every year, inflation eats away
Yeah.
around 8 to 10% of the value of our money. 100 becomes 90, 90 becomes 81, 81 becomes 72.
Okay.
So if money remains idle, in few years,
Yeah.
its value becomes zero because cost of living is rising.
Right.
And almost every product or every service that we consume or will continue to consume over the next decades of our lifetime, their prices are rising.
Okay.
So to keep pace with those prices,
A prospect tells me that I am a very prosperous businessman. I had 2 factories, I am setting up 2 more. I am doing extremely well. Should I invest
so
outside of my business?
I think there are two ways to look at it, just in case. And secondly, there are phases when your own business will have cycles.
Yes, I was going to come. Even if you have a superior business, but you can it is business, so it will go through cycles.
It will have its own cycles.
There might be a bad phase.
Absolutely.
Once or twice in a decade.
Absolutely.
From that angle, it makes sense.
Absolutely.
To diversify.
See, mutual fund is actually, like I said, an animal which can probably take you in poor and throw you out rich.
Okay, wonderful.
Hello and welcome everyone to AUM Finance Podcast. This podcast discusses the first principles of investing and is for informational purpose only. We intend to add to the body of knowledge. Please consult your financial advisor before taking any investing decision.
So hi there. Welcome to the interview section of the AUM Finance Podcast. I'm Nirav Panchmatia, and as I've said earlier, the interview section of the AUM Finance Podcast, we interview leading luminaries from the world of money, from the world of finance. We pick their brain so that, we set out the first principles for the viewers of this podcast. Now, you would be wondering, whom do I have today with me? So we have a very leading light from the world of mutual fund. His name is Kalpen Parekh, right? And let me do a formal introduction of Kalpen. Kalpen is the MD and CEO of DSP Asset Managers Private Limited. He had been earlier at IDFC Mutual Fund, now named as Bandhan Mutual Fund. He's had a stint at Aditya Birla Sun Life Mutual Fund and also with ICICI Prudential Mutual Fund. Right, Kalpen, you are very passionate about behavioral finance, and I think we are going to spend a very good time on that topic. And behavioral finance is how an investor behaves. So it is said in the world of money, it's not that the market is going to make money for you. It is your behavior which will decide how much money you make. You are a postgraduate from Narsi Monji Institute of Management Studies and a bachelor's degree in chemical engineering, which is very interesting, from Bharati Vidyapit, Pune. Kalpen, you might not be aware, I am also a MBA from NMIMS.
Great.
I am your junior. So that sets the age very clearly, right? And it's an honor to have a podcast with somebody who's from my own institution and see where you have arrived over a couple of years. So now let us start let's go to behavioral finance, Kalpen. Or let me do one thing. Let's start from the ABCD, 1, 2, 3, 4. Why invest?
Otherwise, money remains idle.
Okay.
And over time, the value of money becomes lesser and lesser.
Yes.
Every year, inflation eats away around 8 to 10% of the value of our money. 100 becomes 90, 90 becomes 81, 81 becomes 72.
Okay.
So if money remains idle, in few years,
Yeah.
its value becomes zero because cost of living is rising.
Right.
And almost every product or every service that we consume or will continue to consume over the next decades of our lifetime, their prices are rising.
Okay.
So to keep pace with those prices, not just to keep pace, but to earn more than that, so that you're always having a positive gap between the cost of living and the joy of living.
Yes.
Because
Cost of living and the joy of living.
to enjoy life, there is a price, there is a cost.
Yes.
And it's always important that if we have a reasonable amount of money at our disposal to do what we aim to do, what we like to do, what we dream to do, money is a very important tool to enable us to do what we want to do.
Okay.
And hence, if it is an important tool, would you want its value to depreciate or appreciate? So that is why you invest.
So one, Kalpen, you said is about inflation. So inflation is like a thief, which every day comes into our house and takes some portion of the money. So we are when we are having money in our pocket, it's like walking on a treadmill.
True.
So you just have to keep walking just to be there.
Yeah.
Otherwise, you'll fall off the treadmill. So that is beating inflation. Another, you said, you use the word joy of living.
Yes.
So that takes care of the desire part.
Absolutely.
So everybody has desires, goals to buy something, one or the other. So in order to meet that, we have to invest.
Absolutely.
Okay. Now the other question is, if you have to invest, what are the avenues available to a common person in India?
I think there are many ways. Now, since we speak of common person, let's remember that 90-95% of us are, common people,
Yeah.
average people who come from middle class backgrounds. So we don't have large amounts of money to start with. We start with small amounts of money. And the best way of investing is financial instruments.
Right.
You have, bank deposits. You can invest in mutual funds. You can invest in stocks. Combination of these three. You can invest in gold. So there are these multiple options that are available to a common man. I'm not using real estate here because typically real estate needs leverage. Most people, I think, invest in real estate using leverage. So it's not something where you earn 10-20,000 rupees every month and you can just start investing. So if you want to invest unlevered without taking someone else's
So when you say
money,
leverage, by taking a loan.
taking a loan. Otherwise, it's very
It's
unlikely.
almost impossible in India to
for
buy
most unless you are already rich.
Yes.
So in that context, investments which take smaller ticket sizes. So you enter with small amount, you exit with large amounts. If you are entering the right train and staying invested for the right amount for the right periods of time. So such vehicles are very easily available today, very easily accessible today through all these financial instruments that I mentioned. The other way of investing is to run your own business, because in business you make money. Of course, 90% businesses don't make money as well, and very few end up making money, and they are all listed in the stock market and reflected in the top 50, 100, 200 companies of India. So either you run your own business and earn superior returns on your capital and on your time, or you partner with someone else's business and you make other high profile, most intelligent, most competent businessmen work for you by owning their business, either by owning their shares or by investing in funds which are in turn owning their shares.
So you answered my second question also, why equity?
Absolutely.
So when you're saying, and why either, even if I have a very good business, Kalpen, okay, myself, why can't I also participate? There will be equally smart people out there.
Absolutely.
Okay. So why only rely on my own skill, my own energy, my own capital, which I have to put in everything, all the resources to arrive at a profit. Okay. So even if I am a prosperous businessman, and you should answer this question, you'd be in a good position. Ki a prospect tells me that I am a very prosperous businessman. I had 2 factories, I am setting up 2 more. I am doing extremely well. Should I invest? So outside of my business?
I think there are 2 ways to look at it. If you're very, very confident that you are going to earn the most superior way of generating long-term returns with very, very limited downside, and if you have that confidence, by all means you can, run your own business and keep investing in your own business, and that business should have ability to absorb capital, but not just be a capital guzzler.
Yes.
But it should be able to deploy that money at respectable rates of growth at superior return on equity or return on capital. Now, many people keep investing in their own businesses because it's the only thing they know, and because there is an emotional connect that, okay, this is my business, I have to keep seeding it.
In Kalpen, I mean, that's a very good point that you made. My experience is most people don't know what is the return on capital.
So that's the point I'm making, that if you invest, let's say, in a combination of good stocks directly or via mutual fund, on an average today, most equity funds will have a return on equity profile of around 16 to 20%.
Okay.
So, and growth rate in terms of profit growth rate between 10 to 15%, depending on company to company.
Yes.
If your company has superior economic profile than this profile, then it's fine to allocate more money there. But if your business does not have visibility that year on year over long periods of time it can earn 16 to 18% return on capital, as well as grow without taking other type of risk, without putting too much of effort beyond a point, then it's good to also de-risk by having some exposure to a diversified mix of businesses, which is ownership of multiple companies across multiple sectors. So I think investing in others' businesses is more about diversification and risk management, just in case. And secondly, there are phases when your own business will have cycles.
Yes, I was going to come. Even if you have a superior business, but you can it is business, so it will go through cycles.
It will have its own cycles.
There might be a bad phase.
Absolutely.
Once or twice in a decade.
Absolutely.
From that angle, it makes sense.
Absolutely.
To diversify. And what you defined is actually a mutual fund. That's my next question.
Yeah.
So when you say you own a piece of business, you're saying it is equity. Now, if you own a couple of business in a basket, that is a mutual fund.
That's a fund.
So in a layman's term, can you elaborate further? What is this animal known as mutual fund?
See, mutual fund is actually, like I said, an animal which can probably take you in poor and throw you out rich.
Okay, wonderful.
If you behave right, and if you respect the rules that
when you enter, you are poor. It will make you much more richer.
Not necessarily you are poor.
Not necessarily poor, but it will make you much more richer.
It can make you,
Okay.
So the more important point is that mutual fund is a collection of businesses. Of course, before that, mutual fund has multiple asset classes. So it's not only equity. But if I come to equity
mutual fund.
An equity mutual fund basically owns between 20 to 50, 60 companies. Across sectors.
One mutual fund scheme.
One mutual fund scheme across various industries, various sectors, even companies in India, companies outside India. It can take you anywhere in the world. So it is a passport to make other people run their business and work for you. And it has this beautiful ability that after 7-8 years, if you don't like this business or you need capital elsewhere, within 24 hours you can switch off from other people's business and get out. But if you're running your own business, you can't switch on, switch off like this. So the liquidity element is very high, and mutual fund also allows you to do all of this without many hassles of actually running a business. So it brings in huge amount of simplicity. Mutual fund has highest degrees of transparency because every day the value of the investments you have done.
Yes.
Though many times it actually is a deterrent of long-term compounding. Sometimes it's better not to know the value every day, but it gives you that level of transparency. You can see where is the investment done on a monthly basis. You have a very high degree of tax efficiency. As I said, liquidity is there and it is well regulated. So thanks to our primary regulator, SEBI, they over the last 10-20 years have done intense amount of work to make mutual funds extremely valuable for the common investor.
Yes.
For either a small ticket size investor or even a large ticket size investor, they have neutralized or equalized the benefits that each investor can get are equal. It is not a function of what is the size of your investment. Whether you invest with 500 rupees or you have 5,000 crores in my fund, all are given equal treatment. It is one of the most democratized vehicle of owning businesses. And aiming to earn returns which are superior over inflation.
Okay. So there's a follow-on question from that. So there are these ultra high net worth individuals, people let's say with 100 crores, 500 crores of surplus money, and they have a school of thought that if my driver, if my gardener, if my maid are investing in mutual funds, then mutual fund is not for me. Is that right perspective, or you want to throw some light on that?
So first of all, any perspective needs to be backed with data. If it is not backed with data, then it is irrelevant, and it is harmful to your own, portfolio construction approach. When I look at data, returns are not a function of size of your investment or your profile, whether you are a driver or a cricketer or a CEO or a large billionaire businessman. In fact, if you take the mutual fund industry, 45 lakh crores of assets, there are all types of investors who invest with us.
Okay.
So much so that some of the largest sovereign wealth funds of the world are investing, in some of our strategies under our advice.
So a sovereign wealth fund is an investment arm or investment kitty of the government.
Of some or the other government, which is creating
across the world,
cash flows.
which is investing.
Absolutely.
So like Saudi Arabia and like Finland,
absolutely,
and so on and so forth, US
there
and
could
all
be
that.
many.
That is a sovereign wealth. So you are saying even sovereign wealth fund, the portfolio of countries they also invest in mutual funds.
So they invest, they take services of mutual fund managers. So we give them advice.
Yes.
Because since their money comes in, foreign currency, there are different vehicles.
Yes.
But the concept is exactly the same. So, so the principle on which we manage a very small investor's money, we manage it in the same way for large investors. So smart investors don't differentiate. वो भेदभाव नहीं करते हैं कि ये बड़ा आदमी का पैसा है, छोटा आदमी का पैसा है. And in fact, our data shows that maximum benefits have accrued to those who invest with discipline, with consistency, with continuity, all through market cycles. And the biggest raw material of wealth creation is time. The biggest enemy of wealth creation also is expense. So many times we've seen, large investors choose complex products with fairly complex fee structures, very high fee structures, non-transparent fee structures. Over time, the returns, all investors end up earning the return of the market minus the costs. Mutual funds, in fact, have transparency in costs as well. Whereas, many complex products where large money tends to go, doesn't even have transparency of cost at times, or cost structures are high, or tax efficiency is not in favor, liquidity is not available real time, money is locked for 3 years, 5 years, 10 years. So I think many people I have observed in my 25-year career, there are enough number of large investors who have cracked the code of simplicity, and who know that it doesn't matter if my accountant is investing in this mutual fund. Doesn't mean I undermine the beauty of the vehicle. Because the product is so good, because genuinely mutual fund सही है और genuinely democratized है, ये उसके लिए भी सही है और मेरे लिए भी सही है.
Or in fact, I got an analogy. If you're flying in an airline, okay, you are a CEO of a company. The guy next to you might be a very lay person. Okay, that doesn't mean you
will not reach your destination.
And it is a fancy thing to own your own aircraft. I mean, even if you are a billionaire and you can afford it, अगर cost benefit analysis करेंगे तो it's not worth it. Right? Hence, there in US, Warren Buffett has a company where they rent the aircraft time, the air time. And so you said two things: the return of the market. Okay.
And I'll just add one more point that a lot of rich people buy iPhone as a gadget. But likewise, even a middle class person may end up owning an iPhone. Now, you don't judge whether you should buy iPhone depending on who else is buying it. If the product is good, you will end up buying it. So I think the utility of the product should supersede your decision on whether it's good or not good versus who else is owning it.
So if I have 100 crores in my pocket, I should still stick to mutual funds. It's as good a financial product in the country as anything else.
I think Warren Buffett ने वो एक bet लगाया था, right?
With the hedge fund manager.
Simple index fund में डाल दो और आप multiple hedge funds में invest कीजिए. Most likely you will you'll get a better outcome in a simple index fund. I am not Warren Buffett, but I think that
Kalpen, I was in that AGM when the 10th year ended.
Okay.
I was live there, and Warren Buffett beat that hedge fund guy black and blue.
Okay.
The hedge fund guy was all over the place over the 10 years because they were compared in the media and all. And Warren Buffett didn't do anything. He just invested in his own, the way he was investing, and didn't change his style. And
I won't over glamorize mutual fund because a lot of it is also a function of when you invest, when you exit, what is your own behavior as an investor. But at large, all I'm saying is that the fundamental rules of wealth creation are, invest in good, don't overpay, and stay invested for long. So any vehicle which allows you to do all three of these.
Invest in first?
In good.
In good.
In good means good assets, good underlying, good stocks, good sectors. If bonds are good asset at a point in time, then invest in bonds.
Invest in good. So depending upon the time when I'm investing.
So where there is value for money. Where you don't, the second rule is don't overpay. So you may be buying a good asset. iPhone is great.
Yes.
If iPhone 12 is giving me the same features as iPhone 15, and still just because everyone is queuing up, the price is 2 lakh rupees, then you're overpaying. You may have money to overpay is a different point, but you're not getting extra benefit of that. In investing, doing that is actually harmful because prices mean revert. They come back to what their fair value is. So if you pay unfair prices, you will not make enough return. So that's the second rule. And the third rule is most of these returns are made over a period of time through compounding. 10% growth over 10 years does not mean 100 rupees will become 200 rupees. it actually means it will become somewhere closer to 350 rupees, purely because that every 10 rupees will earn again in the next year.
10%.
So the longer the time, compounding is much better. And also in the formula of compounding, we all have learned the formula that amount is principal, 1 plus return divided by 100 raised to time.
Yes.
The return has plus sign before it. Principal has multiplication sign after it. Time has exponential sign before it.
Wow, okay.
So mathematically also, the power that time brings to the table is higher than the power that a plus sign or a multiplication
So
sign
you just explained a compound interest formula in a very novel way, and you said, in fact, and I have said it in my compound interest podcast also, that the only factor in our control is n, the number of years.
Sure.
Yet all the discussion between an advisor and an investor happens around kitna return donge, as if it is in anybody's hand.
Sure.
So beyond a point, n is more important, and you said कि n और time period ऊपर होता है.
Yes.
और वही compound करता है आपका पैसा.
Of course, what is equally important, I don't undermine the role of R, because end of the day when we are giving up our hard-earned money, when I am postponing my gratification, I need to know what is going to be my compensation.
A certain minimal level of return.
So a certain reasonable, fair, responsible level of return expectations are important. But it's very important again to know that actually I do believe that we can control R, because if you again don't overpay, then R will be reasonable. If you overpay or if you buy bad asset classes or bad investments, then R could be negative. And negative R compounded with very high time is more destructive. So I would say that we have to ensure that what is the right discipline to ensure that R is a reasonable R and we have higher odds of achieving that. So our behavior will determine R, and our tenor will determine the final amount, the size of amount.
So our rate of return will be determined by our behavior.
Absolutely.
So you don't catch a train where everybody is already crowded and wanting to go. So don't avoid an asset class which is flavor of the season.
Avoid, yeah.
Go to an asset class which is out of favor.
If it is right.
If it is inherently sound. Right. Not just because it is
because it's out of flavor.
Out of favor plus it is right.
Yeah.
यानी equity में तब जाओ जब लोगों को equity पसंद नहीं है. Partly.
But there are times when लोगों को equity पसंद है, but अगर equity सही है तभी भी. See, I feel that when you take a long flight journey, and I'm using a long flight journey because investing is also a long journey.
Yeah.
Normally in a long flight journey, when you take off, there is some excitement or there is some anxiety that okay, everything will be fine. And then when you land, you are again changing your gears and speed. So same with investing, when you are entering in, there is a takeoff, and when your journey is coming closer to your need or a goal coming closer, you need to get out. Now in between there are periods of doing nothing, and in between there will be moments where you will have anxiety, there will be those jerks, and in between there will be moments when you'll feel like sleeping. So just because nothing is happening, everything is cruising and the flight is full, doesn't mean you get out, just for the sake of being contrarian. So we often say, right, if it is crowded, don't be in. The plane be crowded, all seats are full, doesn't mean you don't get in.
So should I interpret that long flight journey analogy as कि इंडिया में एक बार इक्विटी की ट्रेन पकड़ ली तो टेम्पररी वैल्यूएशंस ओवर वैल्यूड भी हो तो ट्रेन से उतरो मत.
ये सब है ना, मुझे नहीं पता है नीरव. I can wear my business hat and say that doesn't matter and all of that, but दुनिया भर का जो डेटा ये दिखाता है कि अगर आपने बहुत ही recklessly overpay किया, तो rest of the world, those companies over a long period of time have also delivered below average returns. Now India में नहीं हुआ है अभी तक. Maybe it can continue like this, maybe it will not continue. Forecasting that future.
So let me rephrase that question then, Kalpen, ki if you have boarded the train properly, you've taken the flight at a right price.
Yes. Stay put.
Then stay put.
Yeah. And take out if you need the money.
Take out if you need the money.
And take out if you have a near-term goal and the flight is flying too fast. And you're making, so मान लो आपको 10 साल में जो रिटर्न बनना है होगा 4 साल में बन गया, और आप वैसे ही एक घर खरीदने का सोच रहे थे, तो लोन लेने के बजाय ये थोड़ा प्रॉफिट बुकिंग करके ले लो. Can be one way of optimizing that.
Okay.
But generally at large, most investors will benefit if their holding periods are very long. And the underlying remains solid.
Okay.
Thank you for listening to the AUM Finance podcast. Remember that all investments are subject to market and other risks, and one should read offer docs and other documents carefully before investing.